Hi, I'm Jonathan McDowall, a financial planner with MHA Henderson Loggie Financial Planning. In this short video, I'm going to provide an overview of cash savings versus investments, to highlight the differences between these two, and to also show why for some individuals, investments can provide an effective option for their money over the longer term. By cash savings, I mean bank or building society savings accounts. These come in different forms. It could be instant access savings accounts, notice accounts, fixed term deposits and cash ISAs. The return that you receive on cash deposits will be determined by the interest rate that the bank or building society provides. In turn, the interest rate they provide is influenced by the Bank of England base rate. Cash savings are regarded as safe and the value of your money will not fall. There is also protection offered by the government under the Financial Services Compensation Scheme. So if a bank or building society were to become insolvent, your money would be protected by up to £85,000. Generally, cash savings are better suited for shorter term needs, so money that you know you may require in the short term or money used for an emergency fund. Whilst savings in a bank or building society won't fall in value, they will be impacted by inflation. Interest rates have been very low since 2009, so over that period you'll have received a very modest return from cash savings. The main risk is inflation eroding the purchasing power of your money. In other words, your money will buy less for you in the future. Investments come in various forms and differing levels of risk. This can range from holding individual shares where you own a small part of an individual company to manage investment funds that can invest across a range of assets and are managed by an expert for you. When investing, the returns that you receive is based on the performance of the assets held. For example, shares, property and bonds. These offer the potential for greater returns than interest rates can provide, and also the potential for your capital to grow or an income to be received that can outstrip inflation, providing a real return over the long term. Investments are generally best held for longer term periods of at least 5 years. Therefore, they're better suited to meet longer term financial objectives. All investments carry some form of risk depending on the type of investment held. The value of investment can fall as well as rise, and you may get back less depending on when the investment is sold and the market conditions at that point in time. The returns received are also variable and they're not guaranteed. Because of the potential risks of investments, they are better to be held over a long-term period. By taking this approach, this offers the opportunity to benefit from the higher returns that can be provided by investments, but also gives you time to recover from any falls in value that may occur along the way. In this graph, we highlight the performance of an average investment that would invest across a range of assets, including shares, property, bonds and cash. This is set against the Bank of England base rate, and it's also set against the Consumer Price Index as a measure of inflation. I've chosen a recent 12-year period covering January 2007 to September 2019. This shows both negative and positive periods throughout the timeline. In particular, it highlights the financial crisis of 2007-8 and showing a significant market event to highlight the impact that had on the investment value, but also the recovery that was experienced after that. This highlights how an investment can perform versus cash savings and inflation over a longer term period, even with a significant market event. It also highlights the potentially greater returns that can be received over the longer term, even with fluctuations along the way. So, for an individual that has surplus capital that they don't require over a longer term period, and they wish to achieve greater returns, an investment can potentially provide a good solution for this. However, it is important to point out that past performance is not necessarily a reliable indicator of future performance. We believe in diversifying and having an element of your portfolio in cash, as well as an allocation to longer term investments where appropriate. Firstly, it's important to have the security of an emergency fund in place, and then have money set aside for use and enjoyment, and then think about the future, and money that you wish to work harder and earn a better return could be allocated to investments. Hopefully this video has provided a useful comparison of cash savings versus investments. If this is something you'd like to discuss in more detail, please contact me directly or leave a comment below. Thanks for watching.